protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
Welcome to the Money Unleashed podcast, powered by Hoffman Financial Group. I'm Eric Johnson. Alongside me is Kyle Allyn. We're the vice presidents of Hoffman Financial Group. You can hear us each Saturday from 2 to 3 p.m. on 95.5 WSB and catch new episodes of the podcast each Friday. So make sure you're subscribed wherever you get your podcasts. Let's jump into the show. What we're going to talk about now, everybody, gambling in the market. I feel that there's a fervor in the market now due to the results of this election. Let's talk about human nature and what happens when people start feeling euphoric in the market. What do they start doing usually?
Well, it's not just that you feel it, right? It is happening. So
right.
The day after the election, all of a sudden the market's through the roof.
Yep.
So, here comes the greed. You've got to be careful. Bulls make money. Bears make money. Pigs get slaughtered.
Yep.
So be careful being greedy. One of the things that I found in the idea of greedy, there's an ETF that was designed by a company called T-Rex, which is funny to me. T-Rex, it's the 2X MicroStrategy ETF, ticker MSTU. It's up 225%, and it's trading $500 billion this year, which is as much as gold. So it's not some random thing. And it's one of these leveraged Bitcoin ETFs. We've talked about this before. So what happens, of course, is you get excited and you get greedy. You come into the marketplace and you start to say, okay, I know what's happening next. I know where the future is going, and I'm going to bet and buy this thing. So it's a gamble. It's like you walked in the casino and dropped it on black. And so I have two thoughts on this. One was I used to think that was bad. After 15 years of watching people in the market, I'm actually okay with it. I think you need to get it past you. So for our younger clients that are in Generation X and they're kind of building that portfolio to retire, get it out of your system.
Yeah.
Just don't get it out of your system with all of your money.
Yeah, use a piece.
Please.
A piece.
Yeah.
Don't throw the book at it, right? Like, get a piece that's aggressive. Let's see what happens. And if you win, great. High five. Never get mad at a green number. And if it doesn't work out, then it's not ruining your situation, right?
That's right. And not only that, if you were to look at the compound effect of a 7% investment, you're going to double your money quickly within the next decade. If you look at a 15% compounding effect, which is something like the Qs, the NASDAQ, the tech markets, holy cow. I mean, it almost blows me away that I get that people get greedy, but to get that greedy tells you that they're very lost on what they're doing because there's so much power in some very consistent, large American stocks.
And I love how you brought up compounding interest because that is literally the keys to the castle. Like, everybody wants to get rich quick. That's not how this game works. You cannot time the market, Kyle. You need time in it. And that's the difference, right? So a lot of our younger clients, maybe Gen X or maybe even younger than that, when they come in, they're trying to build their portfolio and get to these, astronomical. They want to be part of the 2 Comma Club, which I'm cool with. Everybody should. But what happens is they want to do it in a day. They want to do it in a month. They want to do it in a quarter. And that's not how this game works, right? So you need to make sure that you are not over leveraging yourself. For instance, for people out there who don't know, MicroStrategy, it's a technology company that basically their whole fundamental book is in Bitcoin, right? That's what Michael Saylor is doing. He's just buying Bitcoin. So it's a really good proxy to it. And on top of that, it's leveraged. This is an ultra volatile ETF that people are buying into, for this type of exposure. So yes, you're allowed to be aggressive, but you want to make sure you're leveraging the powers of compounding interest. We talk about the law of 72 all the time, and a lot of people don't know what that is. So 8 times 9 is 72. If you simply make 8% 9 years in a row, you double your money. And that's the leverage of compounding interest. I don't think people even understand that concept, but if they did, or they have an advisor who does, that is how you get ahead in this crazy market we deal with. And it's about getting those consistent gains over and over and over again. The next thing you know, you look up and you're like, hey, I got lots of money.
Yeah, and I think the other thing is, and the reason I call it gambling or, operating in the casino, people go from cash to the most volatile thing they can think of, which is so interesting. So they walk past a lot of easy things they can do to make more money. So I'll give you one, right? We talk about this on the show all the time. A lot of people have invested their money in a 401k. Inside their 401k, there are these mutual funds. The mutual fund managers have diversified the portfolio, maybe 5, 10, 15% into international stocks.
Okay.
Right? So the reason they did that is there was a time 20 years ago where those international stocks were doing well. The other reason they're doing that is because they don't have things inside the portfolio to be able to diversify, and they don't want to just hold American stocks.
Right.
All right, well, what if you cleaned up that 10 to 15%, which is underperforming by about 60%?
Yeah.
So right off the bat, your portfolio is going to make more money by being a little bit more efficient. So I'm actually okay with the energy that greed creates, which is let's go make some money.
Yes.
I just think be careful because people jump over a lot of good steps that would help them immediately to gamble. So let's be purposeful with our choices. Let's use that good energy that we feel right now, the market's moving, and then let's use that energy to have appropriate choices inside of those portfolios. It could be as simple as improving your stocks by decreasing your exposure to Japan or China or Germany.
Right. So when we do a portfolio x-ray with people, there's a page that literally lets you behind the curtain, and it shows every single position and how they've done on a 1 year, 3 year, 5 year, and 10-year basis. Now, everyone loves the 1 year because that's what's happened recently. But recently, all the crap has happened to us on the 3 year, right? And when you look at the international stocks that are out there, they are vastly underperforming the S&P stocks that we have. For instance, like a typical Fidelity 500 index. On the 3 year average is making anywhere between 9 and 10% right now. But if you look at the same type of index for the international stocks, it's like 4 or 5. It's a slow horse. You could have twice as much if you just cleaned up that portion of your portfolio and put it into a horse that's running faster and more efficiently. You're going to have better results, right?
And I like to play the game with people when they come in for their first consultation. One of the things that you do is you have the ability to come in and sit down with us. So I think a lot of people say, hey, is that going to cost me? Is that complicated? It is not costly. It is not complicated. So there's a free consultation to anyone that calls in. And what we do is we open up the portfolio, look inside, have a cup of coffee. It's super easy to do. And so we always play this game of, okay, are you in Asia or are you in Europe? Right? There's only two choices outside the United States. So when your money managers in New York decided to put your 401k or your TSP or your 403b into something else, are you in Asia or are you in Europe? So I would urge any of the listeners that are listening to me talk, listening to us have this conversation, let's play that game. Let's find out where you are, and are you in American stocks, European stocks, or stocks over in Asia?
Yeah, and you know what's even more alarming is that 9 times out of 10, people don't even know they have these international stocks in their mutual funds inside their 401k. So that's why it's super important to look at this stuff, because you're like, 85% of the time I tell people your gut is right. And when they come in here and they say, I feel like I'm underperforming, I'm like, you are. Your gut was right. Then we show you. And then it's plain as day. When you see that all the international exposure that you have is underperforming what you could have had in the American stock market, it's eye-opening. So guys, if you haven't had your 401k looked at, give us a call. We can do this analysis for you at no cost. 404-341-6767. That's 404-341-6767. Or you can hop online and check us out on unleashyourmoney.com. Kyle, what we're talking about next, and I don't think people have heard about it before, is the MOVE Index. Talk about it. What is that?
Yeah, so I think a lot of people, if they follow the sort of Wall Street stock market talk of the world, have heard of the VIX, right? So the VIX is a volatility measure inside of stocks.
And what does it measure?
Right, so it's looking at options trading to be able to essentially predict the future. So it's saying, okay, there are people placing bets because they're worried about the future.
They're hedging their bets, right?
Hedging their bets.
Okay, good.
Exactly. So this is just a measure inside of the bond market. So the MOVE Index is looking at the 2, the 5, and the 10-year yields. And so if we see this index starting to give us some awareness about fear, about problems, then you can kind of use that kind of moving forward. So one of the things that people debate, because they don't know exactly why these options traders are doing this, one part was, okay, maybe it's the deficit. So they're worried about the deficit. I think a lot of people were looking at recession, and then now as we've moved into a new political climate and a new world, they're unwinding that trade. So I would argue 6 months ago, a lot of people were saying the word recession. I would argue right now, very few are.
Right.
But the reason I bring it up is because I think there's two things there. And the key thing there is you can look at the bond market to give you some awareness on what's coming next. And then even more than that, because retirees are working on fixed rates, income products, so things like money market or CDs, they've got to pay attention to that change. I had someone come in yesterday, and they had 30% of their portfolio in a money market fund,
Okay.
30% of their portfolio in a 3-year fixed indexed annuity.
Okay.
All right, so 60% of the money is sitting on those interest rates. Well, if they lower them, they being Jerome Powell, they being the government, if they lower those interest rates, that client will no longer be able to survive.
Yeah, they'll be less enticing because they're getting less return because of the interest rates, right?
That's right. So hiring a financial professional to be able to help you navigate the changes in the market is important, but also the changes in the bond market. And so I think a lot of people forget about the bond market. It's just not as sexy to talk about. Let's be honest. Talking about bonds is kind of boring. Talking about stocks is kind of fun. But we see that retirees are mainly living off of these things. So whether it be an annuity product, whether it be a life insurance product, whether it be a money market or a CD, these fixed type investments are very important. And so now as we're moving into this new world with a new administration, we've got to pay attention to what's happening in interest rates. So it's almost like the old discussion from before is the best discussion for the future.
That's true. And you really want to pay attention to your safer vehicles. Like, it's been a fantastic time for savers for the past couple of years due to interest rates going up. And I've actually had some discussions about bonds recently, typically because what do we know? We know that interest rate cuts are coming down the pike. Now, we don't know the frequency, we don't know the amount, but we do know they're coming because the only thing worse than inflation is deflation. So I've had a bunch of people talk to me and say, well, wouldn't bonds be good in the future? And I'm like, well, they could be, but they're a slow horse, right? Interest rate cut, just like a bump, to take about 6 months before it starts reflecting in the stock market.
And that's a great point, because I was thinking about this the other day when I was looking at mortgages. A lot of people came into 2024 and they said, in 2023, we know there were very few mortgages being issued. We know there were very few people buying homes because they were looking at 24 saying, okay, I'll wait, the rates will be better. We even heard people like Bill Ackman saying, oh gosh, they're going to cut these rates 7 times. Well, not only did they not cut them 7 times, the 10-year has gotten higher. So sometimes it's stressful, confusing for the public because they're thinking, okay, I'll wait and buy when the mortgage rate is a little better for me. That should happen when Jerome Powell does the first interest rate cut.
Yep.
Next thing you know, you realize that you didn't see all the elements of these things, of the MOVE index, of the treasuries and how they play with each other, how they operate with each other. So this is why you need a financial professional. It's not that you don't understand treasuries or you don't have context in what's going on. It's that we have our finger on the pulse.
We're paying attention.
And we're paying attention.
Yep, exactly right. And here's another thing, too. We're talking about the bonds, and yes, we're going to see interest rate cuts coming down the pike because we don't want the deflation. But it's a slow horse. And then you got to ask yourself the question, are interest rates going back down to 0 again? No, probably not, right? Which means, are you okay with 60 cents on the dollar? Probably not. So that's another reason why having a fiduciary advisor who has their finger on the pulse of what's happening in the stock and bond market is beneficial to your portfolio, because you nailed it right on the head when we opened up this segment, is eventually when the interest rate cuts are coming down the pike, those CDs, those money market accounts, those treasury notes are going to be less enticing for people if it's right in line with inflation or less than. If you remember those markets before the interest rates went up, you'd be lucky to get a CD for a point, right? And I didn't know anybody back then that was like, hey, I got super excited to tell me about their CD for 1 point. So what's going to happen is they're going to take their money out of these vehicles and put them into something else that's going to make them more. And there are safe vehicles that make you more, and there's aggressive vehicles that can make you more. And the only way to figure out the best ones that's going to fit your personal portfolio is to sit down with one of our great advisors here. 404-341-6767. That's 404-341-6767. Or you can check us out online at unleashyourmoney.com. We'll be happy to get you in front of one of our great advisors so we can do this portfolio x-ray, show you where you're at, and figure out where we need to go.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV 2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.